But isn't there a contradiction here? Because on the one hand, we're talking about how important human involvement and interaction and judgments are when it comes to tactical asset allocation, etc. Yet on the other hand, we're saying actually at the fund management level, humans can't add any value at all. And certainly in the bond space, top-down decisions are crucially important for managing bond funds. Yet we're all sitting here saying, human involvement's really, really important for tactical assets. We may add all the value, but at the fund level, forget it, guys. I just don't think that's true. I don't think you can have that contradiction. And although the CAS Business School gave their analysis, and with all due respect to the CAS Business School, just because the CAS research came out with that 22 years, I don't necessarily. You said it was fact. That's just CAS's opinion.
So in fact, they calculated that.
They calculated it, but there'll be other people that could calculate a completely different number with different analysis. And I wonder, how long does it take? How long would it take a tactical asset allocation manager to prove they add value? Would it take you 22 years of track record? So we don't know that, do we? So I guess if how can you on the one hand say, human interaction is really, really important, but when it comes to active fund management, you say it's not important.
I mean, firstly, in terms of bonds, actually the stats are the average bond fund manager, if you add up all active managers, just as badly as the average equity. There isn't actually a difference, so it's a complete myth. If you actually look at the performance of the average, say, UK active fund in the credit crunch, it did within a fraction of the average passive fund. So this complete myth that somehow this human is going to actually say, I'm just going to spot the market's going to fall 30% tomorrow and do something about it. Some will, some won't, but on average, you're going to get the market return less the cost. This is the maths. If you look at the maths, if the sum of active managers is most of the market, then the return must be the same as the market less the cost. You can't get away from this fact. If the probability is statistically, as I said, 4% of beating the market 3 years in a trot, then fine, some people will beat the market. The question is, can you select those people in advance?
Well, not all ETFs are cheap. Some of them actually end up in total cost being a lot more expensive than an active manager, with no opportunity of outperforming. 100% of ETFs underperform, guaranteed.
Just to say that I think the real danger is that these are great building blocks, and they allow retail investors to pick and choose and select, but how many of them really understand those complexities? Stock lending, synthetic exposures, how many of them are actually looking at the prospectuses, the insurance clauses? There are risks. It's about risk management, and the real danger is that ETFs are fantastic development of our industry, and look at the US market in its massive size, but there's embedded risks that I suspect a large number of retail investors do not really understand that they're taking on.
I think you've seen ETFs over time become much more adopted from more sophisticated investors and then wealth managers, and it's filtering down more and more into retail. The products are wider. There's a wider range and a wider offering. The fees are being more competitive and there's more liquidity. So in terms of how they're applicable to the wealth manager, I think it just gives more options. It is a product that can be used alongside either core or a satellite, but it does give managers more options to execute the risk return, the rewards that they seek. From a plumbing perspective, and in terms of how things work and regulation, so let's not forget that pretty much all of the ETFs are UCITS funds. They are designed to be marketed and sold, under the UCITS umbrella. They're extremely scrutinized, and I would say the ETF industry is one of the most transparent parts of the fund universe.
I think investors and asset allocators need to be open-minded. These are all just building blocks. I think really rather than spending too much time and effort and energy in terms of deciding whether to be in the active space or the passive space, a lot more energy should be spent on, really ensuring that you're clear in terms of what type of exposure you want to take. And then, caveat emptor applies as always, right? Do your homework, dig down into the detail. I think with more choice there comes more complexity, there's more risk. Not all products are created equally. That's where a lot of more time needs to be spent. I agree in terms of the active-passive debate that will kind of continue, and I think what we haven't seen in particular in the European asset management industry are those costs coming down. You look in the States, for example, that's already happened in the active space, already happened in the passive space. So the relative costs that range is a lot tighter.
I am very excited. I think our industry is in the midst of massive transformation. Anyhow, we're all being challenged by new, be it eToro, people doing their own investment, challenging traditional wealth managers. I think the younger generation, very tech savvy. They're going to be challenging us. They're going to be running their own portfolios and saying, I can outperform you using these cheap synthetics. So, and it'll be for us to evidence why and how we're producing better risk-adjusted returns, or how we're reducing risk. I suspect a lot of the things we've discussed in terms of the risks and threats of systemic risk or a major bank failure, only when the next major event happens will we see some of the consequent effects on some of these more complex products.
Ashok, Shah, several people around the table have said there's a crisis around the corner. We don't know where it's going to be coming from. We remember the so-called safe enhanced money market funds in France in particular, and the havoc that they wreaked. Is it possible there's a similar embedded risk in the ETF universe?
It certainly is, and what I highlighted was the reports that come out from BIS and some other, IMF included, which continue to talk about that the biggest flows of money that are going into the emerging economies have been through the ETFs and active fund management. And in fact, the fund management industry, the larger fund managers are going to be classified soon, I suspect, as systemically important institutions, and new legislation is likely to follow fairly shortly. But the point really is that, next crisis we have, all of these ETFs which purport to give you instantaneous liquidity are going to be found to be failing, quite dramatically. But I think I want to go back to the overall, summation, which is that I think it has a very useful role to play in portfolio construction. Of course, as others have said, it requires a lot of due diligence. And what I worry about really is that the next generation of ETFs are going to get more and more complicated. And I would really, expect the FCA to step up to the challenge, just like it did in terms of the bond market, and it made contingent capital COCO bonds, available only for professional investors, and the retail investors basically been banned from owning them. In the market, just can't sell to them, and I would like to see something very similar come into existence, where the retail investors can buy vast bulk of the ETFs, which are relatively plain vanilla, and anything that is more complicated, should be really off limits unless you're a professional investor. And I continuously worry about the swap-based products.
I think I don't want to be too repetitive, but I agree it's a good tool. And I think one of the strongest points is the transparency, which is creating a trust, which is something that the industry still needs with our clients. And I think that will impact also the relationship that we have with our clients. And the only danger is that we are a victim of our own intelligence, that we try to make it more complicated again and kind of lose what we've already set up. But I think it's a tool where we can discuss with our clients and they can understand, but we have to keep an eye on the suitability of which clients it's for.
Well, thank you all for your concluding remarks and for a very lively discussion today, which I've enjoyed immensely, and I think is offering our readers and those engaged in our website some pointers to where the influence of ETFs is leading to in the wealth management industry. Thank you so much.